Happy Thursday. This is Pedro.
Hey, everyone. And this is Chihiro. We are Beyond Stocks, where we talk about all alts, which is investing in anything other than stocks and bonds. And we're just two regular guys who are interested in these asset classes. And we want to bring you experts in the field to talk to you about alts. So today we are very excited to have not only my personal and business accountant, but somebody who's just very experienced when it comes to private offerings. His name is Vince Porter. And since 2005, Vince has led Porter and Company CPAs as president and managing partner, guiding the firm in serving growing entrepreneurs, high net worth individuals, and fund and syndicate partnerships. He's one of the CPA Practice Advisor's top 40 CPAs under 40 in 2018 and has been featured in multiple publications. He's deeply committed to community service, serving on various boards that support low-income school-aged children and advocating for type 1 diabetes, which is a cause close to him since his own diagnosis. Outside of work, he enjoys a great poolside bar, as I do, and staying fit and spending time with his wife, Heather, and their 5 children. So, Vince, welcome to the show.
Well, thank you, Chihiro. That's quite an introduction. It makes me feel old when I hear I used to be under 40 and been doing this for 20 plus years. But yeah, I'm glad to be here. Glad to be a part of it. I'm excited to chat about all things tax, which I'm sure your viewers are riveted to hear.
Well, we rely on experts like you to take care of that for us and stay on top of the rapidly changing landscape, right, when it comes to tax. So for our listeners and viewers, so you and I connected several years ago. It was shortly after I moved here to the Texas, to Dallas-Fort Worth in 2016. So it probably would have been 17 that we first connected. I've referred many clients to you, and the reason for that is not all accounts are the same, which is really to say that not a lot of accounts are going to be going to have like an investor mindset in terms of private offerings, being familiar with that. You've read Lord knows how many PPMs and operating agreements, that stuff, entity structures. And so I found you to be, and your team to be, a resource when it comes to that, because what do? I invest in alts and through private offerings. So tell us about how you gained that experience, first of all.
Happy to. Well, I mean, we'll make a short story long, but I started my career at RSM McGladrey, which is a big national firm. And when I went there after graduating with Southwest Texas, now Texas State, got a job at a big national firm, was super happy. They shoved me in the corner, and I did commercial real estate tax returns for the first 4 years of my career, which at the time I loathed. I was like, this is all I see. There's such a bigger world out there. I want to learn more. But what it did is it really gave me the nuanced technical guidance into how real estate and big partnerships work. And as we can talk about, this is a different animal when it comes to the tax code and when it comes to passive activity rules and depreciation and cost seg and 1031s and ticks and just the line. It's complex, and I'll contend it's the most complex thing in the world. So in the tax world. So I spent 4 years there. Then I left and joined my father, who was purchasing another practice at the time in 2005. And next month will mark 20 years I've been here. I subsequently bought him out. But in doing so, 2008 hit, and everybody knows in 2008, S hit the fan with real estate. And we had a really big entrepreneurial group, a mindset of clients at that time. And they started dipping their toes into multifamily. And I was like, I got this, guys. Let me tell you about cost segregation distribution. Cost segregation depreciation. And they're like, I don't even know why you're telling us this. What does it matter? We're going to have to recapture this stuff on the back end. Anyway, go through all those conversations. We were able to save them a lot of money. It kind of opened up some doors for us. We started doing a lot of multifamily, which we still do to this day. We probably do. Yeah, I think my elevator speech is about 10,000 K1s we're responsible for across maybe 300 to 400 partnerships. So um, we do a lot of this stuff, and we know a lot of this stuff. So um, that's me on the practitioner side. On the personal side, as you know, Chihiro, I've given you my money, and not to toot your horn, but you didn't have a capital call for me, and you gave me a pretty good return. So I was super happy with it. I've invested alongside many of our clients in our deals, and I think that gives me a different perspective from some other practitioners because I know what you guys at the LP and GP level go through when you've got people wondering where the heck are my K1s? Am I getting a K1? What's on this K1? Are we making money or not? And, I can combine the expertise from the practitioner side that we know very well alongside, what are the investors feeling or what are they knowing? And, at the end of it all, I really think, and you guys do a good job of this, is communication at the heart of it. Because we all get busy, whether you're investing or working in your job, or you're pushing out tax returns in a CPA firm. But at the end of it, you got to be able to communicate with people. And I always contend with my staff that our motto is complexity is the enemy of execution. And don't get me wrong, what we're doing here is really complex. There's a lot of nuances with it, and that's why we're in business. But you don't want me to come to you and start beating you over the head with code section and what does 469C say and all this other stuff. So I really try to boil this down to make it really understandable to you guys so that, you can understand it better. You can do more deals, make more money, and then, in turn, selfishly send us more business, hopefully. So,
on that point of nuance, so I have an example that is very fresh in my mind, which is like a partner of ours recommended this tax person with respect to like a self-directed IRA that a prospect was considering opening in order to invest through that vehicle through us, right? So, so then, okay, we have a call with this, or excuse me, an email chain with this tax partner, and he doesn't understand that nuance that you just mentioned, Vince, and so he basically kills the deal, which I'm very frustrated by because my experience tells me, the reason so many people invest through self-directed IRAs into private deals is precisely because that tax liability is so much smaller. It's so much more tax efficient, but this guy just basically destroyed that notion because he was, I don't know, I guess taking a literal interpretation as opposed to a practical real life one. And so that's just an example from my recent history wherein a highly qualified tax professional just failed to grasp the nuance of, like you said, a complex tax situation, and then basically killed the deal for me.
I got you. Well, I mean, how much time you got? We could spend the next week sitting here talking about IRAs and things like that. I mean, that's another thing. I've got my money with the self-directed IRA, so not only do I know it from the professional standpoint, and don't get me wrong, UBIT and UDFI and all that little nuance is important to know, and not many people know it on the tax side, and that can be more taxes to you guys, but I'll save the technical details for later. But I do it, and it's a great vehicle to have. And you know what? It's really cool to drive down 75 here in Dallas and point to that building and say, hey, we own a part of that through my IRA or whatever. And that's way better than saying I've got everything wrapped up in the S&P or something that you really have no tangible control over.
Right. Yeah, that definitely resonates with me. So what are some things that, if somebody already has some private offerings or wants to add exposure to that, to their investment portfolio, and they're thinking about, okay, what should I look for in my partner when it comes to tax strategy and tax prep? Like, what are some things that somebody a potential investor should look for in deciding who their next accounting/tax partner is going to be?
Well, I mean, do they have experience doing these types of investments? Because it's obviously, a lot of CPAs will, if we're just talking about personal work or whatever entity level where you got K1s coming through, well, there's a lot of rules regarding passive activities, and we could go down a whole wormhole of, why some GPs push that all this depreciation is going to save you trillions of dollars in taxes. And then you end up handing your K1 to your CPA and they're like, I'm sorry, you can't take any of it. So you got to make sure they really do understand this stuff. They've seen this stuff before because at the end of the day, it's your tax dollars at play. And there's a lot of different ways to structure this stuff. So I'll kind of give you an example. So let's say I'm an LP on a deal, which I've been an LP on your deals and many other deals with our clients. And I get, you guys do a cost seg. Let's say it's multifamily. We do a cost seg and there's a big loss that comes to me. Well, some people in their mind might think that's great. I can take that loss and then I can offset against my W-2 income. Well, that's not really the case and not always what happens because the IRS taxes you in 3 different ways. So they tax your active income, which is your W-2, your active business income. They tax your portfolio income, which is your interest, your dividends, your capital gains in the markets, your retirement distributions, that sort of stuff. Then they tax your passive income. Passive income is any income or loss from an activity in which you don't materially participate. So now I'm not going to beat you down with tax code jargon, but what materially participate means you're actively involved in the day-to-day operations of that business. So if I'm the LP on a deal, and all
generally speaking, you're not actively involved as an LP. Very seldom. Right?
Yeah, no, you're not. You're not. And I myself am not either. And the reason is because I trust you. I vetted you. I went through all of the due diligence I went through to make sure you're going to be a good steward of my capital. I'm going to let you handle it. I want you calling the property managers if it's a multifamily or if it's a fund of a fund. I want you calling the other people. I got my own life to run here. So that's a passive activity. When you have a passive activity loss, that loss cannot offset active income. So what happens is a lot of people might come back to you as a GP and be like, well, you promised I could take this against my income. Well, you're not a tax professional either. And you may have understanding of this because we've talked about it, but that's not really your area of expertise. So what ends up happening is some CPAs turn their clients off of these alternative investments because they say, well, that's a passive loss. You'll never get to take that until X, Y, and Z. And then they might start hitting them with a bunch of complicated tax jargon. And nobody wants to hear that. So I always want to contend to make sure clients understand this. One, here's why it's passive, and here's how we can make it not passive, or here's kind of the approach you need to take with it, because there's a lot of different nuances with that. But again, it's all about education and speaking to the clients and kind of explaining that stuff to them. But I've always been a big advocate of entrepreneurial aspects. Obviously, I'm an entrepreneurial at heart. Most of our clients have some capacity of entrepreneurialism with them. And it's just cool, to go through a project, and certainly as an LP to invest with a team, and they're able to get you distributions and money back. And I know right now, sitting here in March 2025, that's a tough story to have on some other deals, but we can hit on some of that. But it feels really good, and it's awesome to see, and I'm super excited to keep doing that. And I truly feel like that's kind of the backbone of our economic growth as a country, is allowing entrepreneurials the ability to go out to do that. And then, not to get political on you, but I've always contended that the tax policy is the one and only way the government influences the economy to drive dollars into a certain sector. So
yeah.
like let's just say real estate. You want to get more money into the real estate game as the government, you give a mortgage interest deduction and real estate tax deduction on your personal side. Going back to '08, we gave the first time home buyer credit, and on the commercial side, you know what we've got. We got big cost segregation studies that we could take and take big depreciation. You got 1031s, you got lower capital gains. So all of that is meant to influence that sector to put money there, and that creates more jobs that the government likes, and it creates more activity, and it's all kind of done through tax policy.
Yeah. Yeah, that was wide ranging. Thank you, Vince. That does remind me of a conversation I had with a local tax professional here in the Dallas-Fort Worth area. And she was telling me that and I'm sure you completely agree with this, which is a client comes from a different accountant. They're new to you, and you look at the returns. And for example, passive losses from investing as an LP in real estate have been applied towards their W-2 income, and they're like a medical professional or something. And she said that happens very, very frequently. And
yeah,
I see you nodding your head too. So yeah, this really just emphasizes the point you're making. Like, not all accountants are the same, and it's the tax code's super complex, and you guys specialize in certain areas of tax and certain types of tax strategies and whatnot. And it's just important to find the right person to be your partner when it comes to tax strategy and tax prep.
Yeah, I agree wholeheartedly. I mean, at the end of the day, you're filing your tax return. If that's right or wrong, they're coming after you, the IRS or the state tax agency. They're coming after you, the individual, and you're going to have to pay the tax if it's wrong. Not that there's some penalties that can go back to the preparer if they were just a complete mess, but you're the one paying the tax. And it's not your job to understand this stuff, right? And sometimes you don't know what to ask because you don't even know what it is. So it's really important people understand this. So like going back to your point, if you're offsetting losses from passive activities against non-active activities, that's a bad deal. And what would happen in this simplified case, IRS would come in if they audited you, disallow those losses, make you pay back taxes, penalties, and interest, and then you would be on the hook for saying, "Hey, you should have told me about this." And passive activities are nuanced. Not everybody knows about them, and you got to make sure you vet your professionals to make sure they know what that is. And if knowing what I know, if I was going out to find a new CPA, and I know I had all of these alternative investments, and I'd watched your podcast and saw me talking, or wherever you learned about this, I would ask the CPA, what do you know about passive losses? What does it take to become a real estate professional? And they should be able to articulate that to you in a way that you understand. I mean, if they go on a 10-minute diatribe of reading the tax code to you, does that really tell you anything? I mean, maybe it assures you, but how can you make common sense of that? And that's really what I would make sure they understand. And then once you can get those basics down, then we can really do some deep level planning and talk about how can we structure some of these passive losses. Are they entirely a bad thing if I can't take them? I mean, we contend all day long. If you're an LP and you're selling one deal and it went well and you got gains coming through, and you have all these built up passive losses, you're not going to pay any taxes. Or maybe you don't have passive losses because you only got the one deal and it crushed it. Maybe you can layer it and go buy a new deal and get that, because you can't do a 1031 on the personal side with your own investment.
Right. So I have a question for our listeners, because you mentioned a couple times about doing a due diligence on an operator, because you don't have time and you have them give you the returns. What is some of the advice that you can give someone who's looking to diversify their portfolio, or just basically very new at becoming an LP, how do you go by doing your due diligence? What do you look into?
To vet the operator, the GP.
Yes.
Yeah, that's a great question. So, not to toot my own horn, but I always contend that you guys, the GPs, have more of a relationship from acquisition to disposition with the CPA than you do with any attorney. You work with the attorneys on the acquisition, you work with them on the disposition, you might work with them in the middle if there's a loan modification or if somebody slipped and fell and sued you, but every single year you're working with that CPA. So if I was a LP and I was checking with the GPs, I would ask them, who's your CPA? Have you worked with them for a long time? Because I have seen many K1s come to this office from other CPAs in big deals. I mean, we're talking national firms, we're talking multi-million dollars that was raised in capital. And I can just tell from the clients, one small K1, it's garbage. It doesn't make any sense. So I would start and say, who is your CPA? Do they know what syndications or funds are? If it's real estate, do they know real estate? Because at the end of the day, it makes you guys as GPs look good or bad, whether we're sending you information that's right or wrong, and that's why, we want to be really transparent with you guys so that you can then be transparent to your LPs to say, if they're sitting at their desk on April 14th waiting on a K1 and we know we're not going to get to it, we need to be able to communicate that well ahead of time. And these things aren't the type of returns you can just turn around in a weekend. There's a lot going on, as you know. But I would ask them, who's your CPA? Have they done this before? If they don't have a CPA, that's a red flag, and a lot of them do, because I've got people knocking down our door right now trying to get a tax return done. And they've raised millions of dollars and they're just now thinking about the tax return. Well, the investors rarely see that, but they see that every single year when that K1 comes through. So it's super important that stuff gets done right.
Yeah.
And then aside from that, just general trust. Do they have a track record? Have they done whatever deal they're selling? Have they done this for a while? Obviously, there's a lot of new capital raisers that came into the market in 2019 to 2022. I don't have to tell you guys, but just the amount of coaching programs that went out there and the amount of people raising capital is crazy. And we've seen a lot of good ones. We've seen some bad ones. You need to make sure they kind of have a track record of doing this. And then how do they communicate bad information? Because it's going to happen, right? Things are going to happen on that deal that are not pleasant. And if they shut down and they don't communicate that, that's a red flag. If the deal's going sideways and I'm at risk of losing my capital, I would much rather have that GP reaching out to me to say, here's what we're doing to try to resolve this situation. Here's what we're up against, rather than just one day I learned the thing blew up in smoke and it's gone. So at the end of the day, just with everything, communication is really key.
Communication, like you say, communication is key. And that's kind of one of the biggest challenges that I've seen for so many GPs that just don't bring, transparency, or don't, communicate with, hey, this is what's going on. We're going south. Right. And then they omit it and then just wait until, it tanks. But thanks. I actually have seen in the past several folks not having a good CPA and run into some trouble, right? Or even like besides real estate, M&A transactions, people want to mitigate their risk, right? After acquiring a business selling a business, and they had no idea that they got to pay all this money for Uncle Sam, So definitely, it's something to keep in mind.
Yeah, as a plug to everybody out there that's raising capital, obviously that's one of our kind of big tax planning strategies, and it's not big, it's just kind of common sense to us. But we talk about layering your investments. Like if you've got a gain coming in from one investment, or say you sold your business and you got a big capital gain, then there's some ways you could structure another investment to another deal to help offset some of that gain. So it's super key. Yeah.
I want to switch gears here. I want to ask you, you see dozens, maybe hundreds of partnerships every year. So you're seeing the stuff that's not going on social media. So tell me what deals are look like they've got some tailwinds versus headwinds. Can you speak to that?
You want to know where the bodies are buried?
Yeah. No, don't name names.
Yeah, no, I won't. But I mean, the things we have seen in the last 18 months about, I mean, I've seen not one, not two, but maybe half a dozen Ponzi schemes, just straight
Wow.
up people raising money with the promise that this asset is here, that they're not here. I mean, you've read about them in the Wall Street Journal. You've seen them, and I've got investors wrapped up in it, and they're smart people with a lot of money. So it's, it's not I don't want to say it's uncommon, but so we've seen a lot of that. I mean, we've seen foreclosures, and we've seen capital go to zero for some clients through the last couple of years, and it's especially on the multifamily side, it's been a case where, it's hard to point back to one thing. Obviously, interest rates going up just crazily as they have. Property insurance has been just crazy. All the things that combine to really put a lot of heat on people have made things really tight. But and I'm in some of those deals. I've got a deal or two where I may not get anything back, and that sucks. But you know what? The GP has been upfront with us from day one. I trust them. I'm not giving them my life savings. I'm smart about what I do, but nobody wants to lose their money. But I know the risk we took, and obviously at the pitch when everything went through. I mean, you're selling, everything, hope and dreams and cap rates that'll get you to a 4x return, but sometimes things don't work out like that. But it's been a little bit of a bloodbath this year, especially this year, because in our space we're usually a year or two behind this stuff, because
Right.
obviously we're filing tax returns for 24. um, it started really in 23 with some bad things going down and a lot of stuff. But um, I mean, above all else, man, the Ponzi schemes has just blown my mind.
Yeah,
I
you
mean,
really had me with that one. So you said it was in the Wall Street Journal. So can you reveal what that Ponzi scheme was?
go Google it.
Okay.
But I mean, so there was a syndicator 2 stories above me in the same building. We actually did one of his deals. Thank God it wasn't there, but he had a big portfolio down in Houston and raised a lot of capital. And they were going sideways because of everything that everybody's facing, right? So he started raising capital for another deal, but he was using that capital to then bail out these other ones to keep it from
Wow.
going foreclosed. So,
Got it.
I mean, and he had been successful in raising quite a bit of money from other people, but it's that's a terrible thing to do, obviously.
Yeah.
Got another one where clients got into a crypto asset for a platform through a guy, and just felt like this was something that could hit. And it was, if you guys know Chris over at the Patel Group. He's a social media star. I love watching his stuff, but he shared some of this stuff. But there was a crypto scheme where people were investing into this platform. Call it Coinbase-esque or something like that. An online platform where you buy crypto, you buy and trade it. And what happened was, you put a little bit of money in, you trade it, and the thing goes up, and you're like, "This is great. I'm going to put more money in." And that those gains keep going, and then suddenly, maybe 3 months into it, after putting a lot of money into there, that you try to pull the money out of the account doesn't exist at all. It's completely gone. whoever set this up, basically it was a fictitious asset, and
it.
there's no thing there. And obviously that kind of sucks. But at the end of the day, it's you kind of got to use your brain when you're doing this stuff. And sometimes especially like through 2020 and 22 when money was free, we were paying 2-3% interest. There was all of these PPP money. People were flush with cash. It was just a whole different market. Sometimes people were like, well, I don't care. I'll take some risk and put this money over here, and kind of lost sight of some of that stuff. So it's,
so I did, I put the pieces together. I know who you're talking about, and that was a multifamily operator. But with the crypto, I have read about that scheme that you talked about, where and that can go hand in hand with catfishing as well. I don't think that was the case based on what you were just describing, but somebody catfishes you and you start putting money in, and there's a fake account balance platform that you're looking at, and it looks like your balance is going up.
Yeah.
And then you get wrapped up into it, and you put everything you got into it, and then it's all gone.
Yeah. I mean, that sucks, but I can think of it from my angle too. Like, clients that I had that got wrapped up in this are smart people. They're not dumb. But like, I'm busy running a CPA practice right here. Sometimes, if guy over here that I trust says this is a good deal, he's putting money there, then heck, I'm getting way better than I'm getting in this money market account or whatever. So I'll just throw some money at it, and it can happen. But at the end of the day, you just got to kind of trust your gut and figure out if this thing's been around or if it's brand new. But it's a wild west out there.
Indeed.
We have a saying in the military. It was like, well, my sergeant used to say, check and recheck, because you want to make sure. So you never know, fall into these traps. Absolutely.
That's a good saying. It's scary. Aside from that, what else is going on? What are we seeing in the market and things like that? It's obviously the acquisitions have been way down, but they're starting to pick up a little bit more. The money's still there. And obviously I think we'll see what the administration does with everything and how that opens up deal flow. I haven't paid attention. I think there was an interest rate announcement a week, or maybe it was this week. I don't know what that did, but I'm optimistic that this thing will come back. And obviously, if you've done this thing for long enough, I speak in reference real estate, but there's a lot of different things. But these things all go in cycles, right? Real estate, it's going up and down and up and down. If you're investing with an operator and they've been in this thing the last 5 years, well, they've seen way ups and now they're seeing way downs. They've kind of been through that cycle. But prior to that, it may have been a new operator or a new person that had never dealt with a down cycle. So, I think you really judge people on how they do when things aren't going well. It's easy for everybody to raise $1 trillion when everything is, you can just close your eyes and throw a dart and make money. But when things get tough, how do you really operate that asset? And that's key, because what we've seen is a lot of people that are good at raising money, but operating is a whole different story.
Money can be raised based on charisma, but operating takes a lot of patience, a lot of skill, and I've gotten punched in the face in operations simply due to lack of experience, not knowing what I didn't know.
I know. I mean, I feel for you, man. You went through the school of hard knocks. I mean, I wrote you a check, and then like a couple of months later, the economy shut down, and we had that crazy COVID time.
2020,
that was scary as hell.
Like, only 5 years ago. Feels like a lifetime. That was crazy.
I can't imagine being in your position and being the steward of all this capital and what kind of stress that can create. But
Yeah.
you made it through it, and you were very open at the time, and that's your investors appreciate that. And at the end of the day, that's what you really need to make sure is whoever you're investing with is, obviously, you guys said it best. Charisma can raise a lot of capital, but what are they doing throughout the process of communicating how this asset is doing?
Yeah. Right. Absolutely. Well, this has been amazing, Vince. What are your switching this conversation back to tax? What's your greatest piece of advice that you have for somebody who is an investor in alternative assets when it comes to tax? Like, what's the number one or two things that they should keep in mind in order to make sure they're getting the tax benefits that they need?
Yeah. I'm not going to keep harping on this passive stuff, but I'm going to take the standpoint that most people listening are on this are going to be passive investors
Yep.
at some point in time. So know what Form 8582 is, passive loss limitations, and then damn sure make sure your CPA knows on that. So what this form is, and it's really laid out very poorly, but it captures these losses that you can't take, these suspended losses. And that's super critical, and that's worth a lot of money to you. And guess what? CPAs screw this up all the time. We get tax returns coming through this office where the passive losses are not right, and they don't. Some CPAs, if you, God forbid, please don't be a client that switches CPAs year to year. But when you move from one firm to the next, or go from doing it yourself on TurboTax to taking the CPA, that 8582 is going to carry that passive loss forward. But if you don't have passive income, it doesn't hit your tax return. So you never see a change in your income. You never see a change in your taxes. So you got to look at the 8582, because we've had clients with like $1 million plus of passive losses that just got wiped out because they went from one firm to the next trying to get what they thought was better advice. And this new CPA firm didn't move those losses over. Well, let's take $1 million passive loss at the long-term cap gain rate of 20%. That's a $200,000 cash hit to that person that CPA screwed up. So you need to make sure you understand what passive losses are. They're losses you're carrying forward that you can use against passive income. So when the deal sells, those passive losses associated with that deal will unlock, and they can be used to offset against that gain, or they can be used to offset against the active income if you don't have enough gain. But if you're not keeping up with that, if you don't know what to even look for, you can lose those, and that could be a tremendous tax hit to you. So we're really big on making sure those passive losses are carried forward. So just so you guys know, the only way to unlock passive losses are one of two ways. You got passive income. You have passive income when passive activities sell and they have capital gains, or that deal itself closes down, effectively sells. Then all the losses can be offset. But that's the real key advice. I mean, other than that, just work with somebody that certainly understands this stuff. If they can't articulate that sort of stuff to you in the first, if you ask them, then I would be wary of working with them and going through there. And trust me, as you said, Chihiro, tax code, court cases, and everything else is like 70,000 pages. I'm not going to sit here and act like I'm an expert in merger and acquisitions and Chapter F reorganizations or that sort of stuff. There's so much to the tax code that we've kind of chosen to narrow our focus so we can be a lot more valuable to our clients. So we won't take on something that we just have no idea in, because we could be in the same boat that some client coming to us from a CPA that didn't know this stuff could be in. So
yeah, the analogy is, in that sense, an accountant is like a doctor, right? You're not going to go to a nephrologist for a neurological issue, because doctors are what? They're specialized, and accountants are as well. But I guess what's harder with an accountant is I know that you're good at partnership accounting, but I don't know, because you're not titled a partnership accountant. You're just an accountant, right? You're a CPA. So the
Yeah.
name, the job name doesn't change,
Yeah,
even though you're
and
specialized.
we don't do a real good profession of just actively marketing and doing that sort of stuff. So I mean, you know, the way we built our business is really going back to just referrals and things like that, trying to get indoctrinated into the thing. But I agree, like there are CPAs out there that position themselves as real estate CPAs or CPAs for dentists or things like that.
Yeah.
You know, that makes it really clear and obvious to those clients what it is they do and what they don't do.
Yeah.
Yeah.
Well, amazing insights. Pedro, you want to wrap us up here?
Yeah, absolutely. So for those that have been watching, and I've been actually looking at the Facebook, LinkedIn with some comments, but somehow it is not popping up here. But I'm thinking, you know, there's a lot of information as far as like investors or entrepreneurs looking to understand, you know, taxes or so. I think in the future, maybe we can probably have some little segments about, like you talked about, self-directed IRAs, how the tax works on those, and have little segments in the future. So if the audience says, hey, we'd love to hear this, I will definitely let you know, Vince, hey, I think the audience is asking for this, right? I think it would be great information, because there's so much that I don't know. And I'm like, wow, this is great stuff, right? So absolutely. So if you guys actually been watching this, go ahead and comment. Let us know what you want to learn next time about taxes with Vince, and we'll definitely put something together. Other than that, subscribe to our channel. Go ahead.
Vince, sorry, Pedro, before you take us out, Vince, how can people reach out to your firm?
Yeah, I maybe comment on there, but my email address is Vince, VINCE, at mytexascpa.com. It's MY, state of Texas, TEXASCPA.com. And we can share more about what we do. And if you've got any interest, then we can set you up and get you on a new client discovery call.
Absolutely. So if you guys make sure you guys subscribe to the channel and download our podcast to Apple. We are on Apple now, so definitely. All right, guys, till next time. Take care.